Hi there, I'm Tiffany Rodius from the Guyana Revenue Authority. This week's focus, reasons for the Commissioner General to reassess a tax return, when you can file an objection, and everything you need to know about registering a partnership. Focus on GRA begins now. A liability certificate is typically requested when applying to other agencies for specific services offered, such as pension benefits, gratuity, small business bureau, firearm license, etc. Simply complete the liability application form and submit it to the liability desk at any GRA office. You must indicate the purpose of your application. You should receive your liability statement within 2 to 4 working days if there are no outstanding tax returns or taxes owed. Applying for a liability certificate is free of cost. GRA, your partner in development. Welcome to Focus on GRA, a program of information for taxpayer education. Where 2 or more people combine their resources to form a business and agree to share risk, profits, and losses, the operation is referred to as a partnership. As every other income earner, partnerships must honor its obligations with the GRA. Carlita Edwards tells you everything you need to know about registering your partnership.
The Guyana Revenue Authority finds it necessary to educate taxpayers on important subject matters with the aim of promoting compliance with Guyana's tax laws. This feature is aimed at providing information relevant to a partnership. If you're in business with 1 or more persons, you are in partnership. A partnership business, by definition, consists of 2 or more individuals who combine their resources to form a business and agree to share risk, profits, and losses. Individuals who are in partnership are required to register the partnership business with the Deeds Commercial Registry, where they will obtain a certificate of registration. The partnership must be registered with the Guyana Revenue Authority for tax purposes. In order to do so, the partners must make an application for a partnership TIN. To obtain a partnership TIN, the following documents must be submitted: completed application form, certificate of registration, copy of national identification card or passport for the partners. Additionally, taxpayer identification numbers for all partners must be provided. So, as a partnership, each partner must have an individual TIN. Section 66A of the Income Tax Act, Chapter 8101 states, where a trade, business, profession, or vocation is carried on by 2 or more persons jointly, the income of any partner from the partnership shall be deemed to be the share to which he was entitled during the year preceding the year of assessment in the income of the partnership, and shall be included in the return of income to be made by the partner. In view of this, a partnership must file an information return to report the income, deductions, gain, or losses from its operation, but it does not pay income tax. Instead, it passes any losses or profit to its partners. Therefore, the partnership income must be computed and then allocated among each partner for assessment purposes in accordance with the terms of the partnership agreement in existence in the year of income. Thereafter, the income of any partner derived from a partnership must be included in his or her personal income tax return and assessed upon the individual as part of their chargeable income. The portion of chargeable income or profit of the business attributable to each partner is taxed at the rate of 28% or at the rate of 28 and 40% as specified in Section 36 and 36A of the Income Tax Act, Chapter 8101.
Need to apply for a taxpayer identification number or TIN from the GRA? Here is what you'll need: ID, passport or affidavit of identity, and proof of address. This can be a utility or internet bill, renter's receipt, or a mail bearing GPO's official stamp. Provide the original and copy of these along with the completed application form. It costs $1,000 for a new tin and $2,000 to reprint a lost or damaged tin. GRA, your partner in development. Welcome back. We turn our focus now to assessments. Did you know the Commissioner General can raise an assessment? Fabian Klaus answers why this is done.
Although the law requires every person earning income or carrying on business to deliver or submit a return of income and estimate the amount of tax payable, this in no way releases the Commissioner General from his obligation to assess every person chargeable with tax. The Commissioner General may proceed to conduct a thorough assessment of the particulars of the tax return as soon as after the day prescribed for delivering the return, and he can determine it was not reflective of the taxes due and payable. Where a person has not delivered a tax return on or before the due date, the Commissioner General may make a provisional assessment of their total income that is subject to tax. A taxpayer may fail to submit a tax return for various reasons. The most common are highlighted by tax specialists from the GRA's Tax Advisory Services section, Marcel Evans.
For example, you stayed, say, 6 months before you come into GRA. We are assuming the business is still operating, you're receiving income, and you're not giving us anything. All right? The system automatically pulls that information. When it pulls that information now, an assessment is done on you, regardless if you're earning or not. We find persons come to us and say, oh, let me give you the example. For the last 2 years, we had COVID, so the business closed down. We're not doing anything. The only way we would know that is if you write to the Commissioner General and you inform us. Well, due to COVID, we have ceased operation, but you have ceased operation for now. You plan to open later.
In accordance with Section 99 of the Income Tax Act, Chapter 8101, if a taxpayer fails to file a tax return as required under the Act by the due date specified therein, the taxpayer is liable to pay a penalty of 10% of the amount of tax assessed. Returns filing is required under Section 60 of the Income Tax Act by every individual earning income and by a body of persons registered in or carrying on business in Guyana. The return is required on or before a prescribed date in every year and must include income from every source earned in the year immediately preceding the year of assessment. If a taxpayer fails to pay income tax on or before the due date, the taxpayer shall be liable to pay a penalty of an amount equal to 2% per month of the tax outstanding for each month or part thereof that the tax remains outstanding. However, the interest may be charged on a compounded basis at a rate of 18%.
We raise an assessment, we send it out to you. When we send it out to the taxpayer, now the taxpayer comes to GRA. I received this notice saying I owe GRA, say, $500,000 for this period to this period. Right? Now, how could this be rectified? When you come into GRA, then you say, I was out of business due to COVID. But you didn't inform us. Now that assessment is already in the system. There's a fixed late filing penalty that is attached to the individual income tax return. Now, also, with that 10% fixed late filing penalty, is also 18% interest and a 2% late paying penalty.
In circumstances where the tax liability has accumulated exorbitantly, the taxpayer can enter into a payment arrangement with the Commissioner General through the Debt Management Division. The division functions to collect unpaid taxes assessed, unpaid self-declared taxes as indicated on taxpayers' returns, and unpaid advance tax installments. Notwithstanding the power of the Commissioner General, any person who is in disagreement with the Commissioner General's assessment may object in writing by registered post.
If you want to contest an assessment that has been raised, you can file an objection. Here is how.
If a taxpayer believes he was incorrectly assessed by the GRA in relation to his or her income, property, or corporation taxes, that taxpayer has the right to object the decision. Lydia Sharma, Group Leader of Objections and Appeals, noted a taxpayer has 15 days to file an objection.
That taxpayer must provide evidence of same. The taxpayer must object in writing, specifically in writing, and it must be sent by registered post. He or she must state their grounds of objection, their specific grounds of objection for same to be entertained.
The notice of objection will be registered when it is received by the GRA, and the taxes will be held in abeyance until the case is reviewed, Sharma explained.
That part to which you're objecting is not payable until the objection is determined.
Sharma cautioned a taxpayer will have to pay the taxes that are not in dispute. Taxpayers will be required to present evidence and documentation to support their claims during the review of their objections.
The onus of proving the case is always on the taxpayer. So if we require any additional information or documentation records, the taxpayer would need to provide same. That will be dependent on how long the objection takes.
After the review of the objection, the Commissioner General will inform the taxpayer of his decision in writing.
After an objection has been reviewed, the Commissioner General may either amend the assessment, maintain it, or discharge it. If the assessment is amended, it means the taxpayer would have to pay part of the amount that was held in abeyance. The other part would be discharged.
The objection process is similar for a VAT registrant that thinks an incorrect assessment or decision was made with respect to VAT. However, the VAT registrant has 20 days within which to file an objection. Additionally, the VAT registrant must also pay all the taxes not in dispute before the matter is considered.
Finally, our tax specialist, Sesnarayan Ramnarayan, joins us this week to answer queries about paying advance taxes.
Today on Your Question in Focus, I have Mr. Sesnarayan Ramnarayan, who will be providing information on the payment of advance tax. Mr. Ramnarayan, can you tell us who are required to pay advance taxes and how a self-employed person can determine the amount of advance taxes to pay?
All self-employed persons and companies are required to pay advance taxes if they carry on any business undertaking in Guyana. Self-employed individuals are required to pay advance taxes on a quarterly basis based on their previous year return submitted to the GRA. For an individual who is not in their fourth year of business to determine the amount that must be paid each quarter, they must divide the tax paid for the preceding year by 4. However, a self-employed individual who has recently commenced business undertaking will be required to estimate their profits for the fourth year, calculate the expected taxes, and pay quarterly installment.
Can you also tell us the due date for the payment of advance taxes?
Self-employed persons are required to pay advance quarterly income tax by the following dates: April 1, July 1, October 1, December 31. Companies are required to pay advance quarterly corporation tax by the following dates: March 15, June 15, September 15, and December 15.
Thank you, Mr. Ramnarayan. It's always a pleasure having you on the program. If you need additional information, please feel free to visit our website, or you can email us at grapublicrelations@gmail.com.
And that is all for this week's Focus on GRA. Don't forget, you can send us your inquiries via email at grapublicrelations@gmail.com or taxadvisory@gmail.com. Our website is gra.gov.gy. You can also follow us on our social media pages for up-to-date tax-related information. Thank you for watching. I'm Tiffany Rodias. Until next time.